Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The markets reacted positively to the basket of news released by the USDA today. March corn posted a 14.25 cent trading range, and the last time it posted a range this big was 4 months ago on September 11. Unfortunately for corn, it managed to only close at about 50% of the day's trading range, and so it remains to be seen how much strength it really is going to have, as opposed to being carried by soybean and wheat, who were also quite strong today in their trading. You'll notice here in our analysis that the contract has been trading inside of volatility-based support, and it is right inside of the band right now. So currently, the price level of about 360 is going to be very important for this contract. Once it's able to make a close above 360, we'll notice that the price level of 371 is going to be key for a potential change in trend, because it is at around this area that the last major pivot low was made. And so current lows are sitting right at about 350 or so. And so the market needs to make an advance up to previous lows and even breach it to give us the first indication of potential strength in the opposite direction. Until then, our bias continues to be to the downside, and the next area that we're looking for the market to test is right around the 338 to 345 zone. We've also run data analysis of volume at price stemming from the July 14 high. As you can see here on this chart, the point of control sits at 389 3/4. So once we're able to get above this area, then we will start to see a true change in trend. This previous pivot low is going to be the key area that this market needs to test first and trade above before a new trend to the upside can be confirmed. And in addition to that, one standard deviation away from the point of control sits at 373.5. So once this market's able to penetrate above these two key levels, previous pivot low as well as 373.5, it's at that point we'll begin to see a potential change in trend. The December corn contract traded in a similar fashion today, and we want to take note here that 376 has actually been very strong support for this contract. The next major area of resistance just above is at 386. And you notice the market briefly penetrated that area earlier in trading today, but then reversed and came right back down through it. So whether we get a close above 386 or a close below 376 will be a key area of demarcation with regards to the next trend or the next movement of price action. Our bias continues to be that the market will probably trade sideways to down with regards to corn. And the primary impetus or the primary catalyst for today's move really has been the strength in soybean and wheat, carrying the corn contract slightly higher today. For those of us who are keeping track, the December corn contract has its point of control at 396 3/4. And currently, one standard deviation below that level sits at 386 3/4. And you notice that price right now is essentially trading below 2 and 1 standard deviations below the point of control. Market's going to need to get above that point of control, or rather, it's going to need to get above the 1 standard deviation mark below point of control, or break below recent lows and then trade lower from there. Last week, we discussed the possibility of the March beans contract dropping into support near 849 finding support there, and then potentially tracing what we have here is our blue line right along this triangle for this chart. It appears that the movement of the market did just as we anticipated. We highlighted in yellow the movement that we saw. The market broke up to the upside today and ended up closing nearer the top side of today's trading range. We also like the way the stochastic is starting to move up from being oversold and appears to be on its way up to the overbought area, which would be an indication of potential strength for this soybean contract. The January 8th to the 12th window is where we're looking for a low to come in and for the market to move up for the next few weeks going into February. And if all things continue to hold as anticipated, that's exactly the type of movement that we're seeing with regards to this contract right now. We will continue to monitor its progress, but for now, the key areas of resistance that we're looking at are potentially near 889 or 890, and beyond that, we're looking at about 900 for the next two key levels of potential resistance for this market to turn down. It's also possible that we could see it continue to trace up along this level here, and it would be near this 900 level that we mentioned just a moment ago, that the next key area of resistance would happen, at which point the market could trace down just a bit. And if we get a shallow pullback, then we can see the market actually move back up again, at which point we would draw a new geometric shape to try to trace out for us the natural movements of this contract. Interestingly enough, the March soybean contract has its point of control right at the 888 level, which is very close to the 890 level that we mentioned a moment ago. So above 890, market can find strength, at which point just above 900 at about 915 or so would be the next area of key resistance. And if it's able to blow through there, you'll notice here that there's not very much volume at price between the 915 area all the way up to about 950. And so once it's able to get through 915, we would look for or anticipate a very fast run to about 950, at which point it would find potential major resistance. The November beans contract has been quite strong at the 870 area. In fact, it has now formed a higher double bottom when compared to the last pivot low that it made here at pivot number 11. So this higher double bottom, coinciding with the market being oversold and moving up from being oversold, is potentially an indication of strength. The next area then we would look for the market to eclipse is about the 901 to 902 area. And upon eclipsing that zone, it would then be able to potentially make its way through resistance, at which point our next key zone would be the 945 area that this contract would look to with regards to its next key area of resistance. The point of control for this contract is at 889 and a quarter, and that's exactly where it found its fiercest resistance today. Above 889 and a quarter or 889 and a half, our next area of resistance for this contract based off of volume at price would be at 907 to 910. And above there, really, we see that there's not much volume at price until it gets all the way up to about 950 or so. So again, like the March contract, once and if it's able to blow through this 910 to 915 zone, we're looking at a nice advance, potentially all the way up to 950. Comparatively speaking, the July wheat contract made a perfect low at the 468.5 number. The reason why I suggest that this was a perfect low, if we measure the recent swing all the way down from here, and if we take that swing in its pieces and chop it into Fibonacci ratios and measure the swing from this pivot to high down to the low that we now see, that number right at 61.8% is in fact the exact low that we're sitting at. That low also happens to coincide with volatility-based support. And given those two pieces of data coming together, we now must consider the possibility of an advance or a run that goes up to test volatility-based resistance up near the 510 to 520 number. Over the next 5 to 8 trading days, it'll now be on our radar for a possible up move that goes to test volatility-based resistance. That would also produce for us a potential lower double top. So resistance that meets up against previous highs and then perhaps collapses is a potential. But if it's able to run through volatility-based resistance, then we may in fact have a new trend and a higher low may ensue there afterwards. But for now, the possibility of an up move looks likely, as the market now had been oversold and is making its way up to potentially being overbought. So we're going to be curious to see if the market makes a run up to the 510 to 520 area over the next 5 to 8 trading days. In closing, we'll have a look at the February crude contract. Recently, OPEC has decided to bring forward or to move a meeting earlier to address the oversupply issue. We can see the market continues to fall down very drastically. Now, we had talked about the harmonic price levels from the initial impulse of this move, and we will notice here that at the harmonic circles or at the harmonic levels, the market made a low and the market then reversed and dropped. The market moved up into the harmonic circle and then dropped. And here, most recently, the market moved sideways into our harmonic cycle and then it dropped. Now, much like throwing a rock into a pond, as the ripples start to get further and further out, the energy will start to dissipate, at which point we would probably need to redraw or to create a new impulse swing to determine where the next harmonics exist. But enough of that. What we're looking at now are the potential terminating levels for this move to the downside. Much of the industry right now is talking about a potential move down to the $20 or even $10 level. We don't know that the market will necessarily go down that far, but we have two spots right now that we're looking at for key support. First, the market hit key support today, and we could very well see the market pause here and make its way back up for a nice small correction. If it's not able to hold at the current levels near the $30 mark, then we would be looking at $26 or so for the next key support level before crude is able to pause and potentially either go sideways or even inch up marginally for some support. Thank you for joining us this week for our market update, and we look forward to reviewing the markets with you again in our next session.